Hi, and welcome back to the Business Career College video series. In this video, we're going to look at the holding company. Now, the holding company is really just a term that we apply to a company. It doesn't have any particular meaning other than just to identify the role that this company fills. You would need this information mostly at the financial planning level. This is not so important at the introductory level for, say, a mutual funds or securities or life insurance licensing course, but this is quite important from a planning perspective. The holding company is primarily a planning tool. So really, what identifies or what defines a holding company is that it doesn't own active assets, but rather it owns passive assets, and generally those passive assets are going to be shares of another business. So generally a holding company would be the major shareholder for another business. So here's why we would do this. Maybe this will help to understand the holding company in general. So we have here an operating company. And we'll give this operating company just one shareholder. So we'll have Susan up here, and Susan owns 100% of the shares of this operating company. The operating company is doing well. We're going to give this company $1 million of assets. And we'll say that last year the operating company generated $500,000 of net income or earnings, and out of that Susan was able to make all of her living expenses with $300,000. So Susan took $300,000 of that out. So we have $200,000 that's retained here in the operating company. Now, if this company were doing purely active business, then you might not have to go through these steps. But at this point, Susan says, well, now I've got a little bit of an issue here. I've got this money retained in my company, and it's really my money. But if I take it out, I have to pay personal tax on it. So she considers some of her problems here, that to pull those funds out, it's subject to personal tax. If she retains it in here, then it's subject to claims by her creditors. She might be thinking about succession at some point. So she might have somebody who's interested in becoming a shareholder of OpCo, but the problem here is that when you have this kind of money, this retained earnings here, it's that much more expensive for another shareholder to step in. Susan doesn't want another shareholder to have access to that money necessarily. That's the money that she earned. So really what she's looking at here is possibly some concerns then, and we've started this list already in a sense, concerns around maybe creditor protection of assets. Although you have to be careful with that. There's a fairly well-known case in BC in which creditor protection was overturned simply because we used the term creditor protection. We might be concerned about where to own some passive assets. We might just want to keep our business pure, although you have to be careful here. We'll see in a minute that this is not necessarily going to help you to use the lifetime capital gains exemption. There might be some concerns around the timing of taking personal income, where she says, hey, I'm already at the top marginal tax rate with $200,000 of income. I'd rather leave some of this, with $300,000 of income, I'd rather leave some of this $200,000 in here and take it out later, maybe when I'm in a lower tax bracket. Maybe there is this succession issue of some sort, looking to bring in another shareholder. So what Susan might look at here, and we'll give her a 0 ACB for these shares. So what she might do here is she might go and incorporate a new company here. We'll call this new company Holdco. And Susan is going to own 100% of the shares of Holdco here. And now what she does is she's going to use Section 85 of the Income Tax Act, and she's going to roll her shares of OpCo into HoldCo. Now we'll do this nice and easy. You can certainly get fancier with this, but for now let's keep it nice and easy, where she rolls all of her shares of OpCo into HoldCo, making HoldCo the 100% shareholder of OpCo, and all Susan has to do is take some shares of HoldCo in exchange. So she just takes some additional shares. She's still the 100% owner of HoldCo, and she uses Section 85 of the Income Tax Act, which allows a rollover. It actually allows her to choose any elected transfer price between the least of the undepreciated capital cost or fair market value up to the most, at the most, the fair market value of these shares. So she can choose anything in this range. What she probably does here, and not to complicate things, but this is actually fairly important, is she chooses an elected transfer price equal to her available lifetime capital gains exemption. Now we have to be a little bit cautious here, because in the case that I've drawn over here with $1 million of assets, of which 2 million or 200,000 are passive, if you've watched the lifetime capital gains video, you'll know that we've now broken the rules that allow us to use lifetime capital gains exemption. You'll recall that at least 90% of this company has to be active assets in order to do this. So what she could do is pay herself a $100,000 dividend, leaving only, and actually that wouldn't quite work, sorry. She'd have to pay herself, I believe, a $111,000 dividend, leaving $900,000 of assets, about 90,000 of which are passive, and then we'd be okay. She could use the lifetime capital gains exemption, and she could then increase her ACB, so that later on, if she sells her shares of HoldCo, she has less capital gains to worry about. So for example, if her lifetime capital gains exemption is $800,000 today, then she can use an elected transfer price of $800,000, use her lifetime capital gains exemption to wipe out the tax on that, and increase her ACB to $800,000, which really helps with estate planning down the road. It's not something that's going to fix any tax problem today, but this now becomes something of an estate planning solution, or a solution for when she decides to divest herself of her shares of HoldCo. Now, at some point down the road, this allows her to do several things. So she can retain earnings in HoldCo rather than have to pay them out personally. Basically, she can take money out of OpCo, retain it here in HoldCo. That's a tax-free intercorporate dividend. And that would only be taxable when she takes that out personally. And that now makes that no longer an OpCo asset, but rather a HoldCo asset. So there's an element of creditor protection, but as I previously mentioned, you have to be a little bit cautious with that. You don't want to oversell that creditor protection feature. And then we have other advantages here. So for example, now she can sell shares of OpCo. Maybe she has a child who wants to get into the business, or a manager who wants to become involved, or something like that, and she's only selling the active assets, which makes OpCo's price then based only on what it's actually generating in terms of revenue, rather than trying to sell ownership of these passive assets, which is a fairly expensive thing to raise capital to acquire. And then we have other advantages here. It just cleans up the business. And in the sense that now she's separated out her various business activities, and you might look at the possibility of selling OpCo later. So she could sell OpCo and retain HoldCo down the road, and essentially use HoldCo sort of like an RRSP, where she uses HoldCo to do a bunch of investing, and she just pulls money out of HoldCo as she needs it to fund her retirement, or whatever financial needs she has later on. So just a general sort of discussion about the holding company and the role of the holding company. It can get much more complicated than this. I hope that helps. Thank you very much.